Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm a guy sometimes people call the mountain, and I'm here with Sir Ryan Isaac. Ryan, what's up?
You're more than a guy who sometimes is
I'm a
referred
guy.
to as a mountain. One of my favorite stories about the mountain is at the summit in Park City this year, and I was talking to somebody, and they were looking for you, and they were like, "I'm looking for the mountain," and then they saw you across the room as a mountain peak does stick out above the clouds and the valleys, and then they were like, "There, that's the mountain. Can you introduce me?" And then we made an intro, and then I don't know I don't know what the phrasing is, but I slinked off into the shadows.
Did the little back pedal,
like the Homer Simpson into the bushes,
into the bushes. Yeah, he and I chest bumped. Sparks flew. Emotions ran high.
Yeah. So good.
It's all good. Today,
let's go. What are we doing?
We are talking about
what are people signing up for today?
People are signing up for everything you need to know about retirement plans.
Yeah.
We've been doing this for a long time. As people, the cool ones know. We do this for a long time, and we're on episode, I don't even know what, almost 700. Yeah. Almost 700. And so we thought, you know what? Let's go back and refresh some episodes, some things that I think would be helpful. So we've gone back to the archives and found some. So this was our second ever. I say we, I wasn't here at the time. This was the second ever episode that you and Reese did on the Dentist Money Show, which was everything you need to know about retirement plans.
This was number 2?
Number 2.
So the fall of 2015.
This was the second. Crap. Oh, sorry. You know what? I misspoke. This was actually number 53. Okay. I built another outline we're going to be doing soon. I think actually today we're going to record this after this one. Okay. The number 2 episode. So I misspoke, but it was 53rd. So it was still in the first
Dude, you know what's crazy is I remember as we were coming up on episode 100, just feeling like this is a scam. There's no way. There's no way we're getting past 100 episodes. We've already repeated ourselves 5 times. I don't know what we do from here. It's so funny to be here. And not only to be this far down the road, but to be repeating things that we used to do. But it's so relevant. So we can jump into it. One of my first questions in just hearing this title alone, Matt, is do you think people have a connotation of what retirement plan means? We say retirement plan as a phrase meaning one kind of specific thing. What do you think people are hearing when they actually hear that phrase?
I would imagine people think immediately of 401ks. That's what I think people would think.
Okay. Yeah,
is that what you were thinking?
Yeah, the plan at the office. I did wonder if some people, and just so we can just clarify as we get into this, I did wonder if some people view retirement plans as just a broader category of what's going to happen. Yeah. Where do I put money in general, and where do we put it in general? It could be real estate portfolios as my retirement plan. So specifically, we're talking about the type of investment account retirement plan that usually sits at a corporate level, the office level, the different types, the thresholds, when they make sense. And we'll probably, I think, get a little bit into a little bit on the personal side of, if you don't quite make enough, right? And for a retirement plan in the office, or it's not an option for you. Yeah,
cool. That's a good point. I probably answered that question through the lens of a nerdy advisor, because that's what I immediately think of when I say retirement plan. But you're right. I'd say most people might be thinking more broadly, just my plan for retirement. So
yeah, okay.
But to your point, we're going deep. We're going deep in how do I know which plan to have at the office in the practice. So let's just start with kind of the questions that we hear generally from dentists around this topic. I actually just had a conversation with a dentist yesterday, not a client. They were calling to inquire about our services. And she was asking a ton of questions around deadlines, and she's transitioning from a simple to a 401k and all this kind of stuff. So we'll get into all that. But I thought maybe we'd break down common questions we get depending on career stage. So for example, a dentist who buys a practice and there's already a 401k in place. What do I do? Do I keep it? Do I get rid of it? Do I start a new plan?
Okay.
Another question for an earlier career owner question might be, my staff wants to put a plan in place. Where do I start? Any other questions come to mind for you?
Yeah, it's funny. I think this conversation gets backed into sometimes from that leads with taxes. So a lot of times the question begins with a tax question, like how do I lower taxes, or am I paying too much in taxes? How will I know if that's the case? And then eventually the retirement plan becomes. I'm sure that's part of this here. It becomes a huge part of the discussion. Which retirement plan do you have at the practice? Is it the biggest, most efficient one that you can have for that given year and your exact scenario? And are you maxing it out to its fullest capacity, including maybe even spouse, kids, whatever it's going to be? So,
Yeah, it's a good
yeah,
point.
I think it gets back into from the tax question all the time. Maybe it's just relates to the first question, which is just like, what am I supposed to do? I have a business now. Aren't I supposed to have like a plan at the practice and like do something with it? So,
Yep.
yeah, really common stuff.
I'm glad you brought that up too about the taxes, because I think it would be helpful for us to highlight as we get into this of like what's like the sequencing of priorities of setting up a plan in the first place.
Yeah.
Like why would you set up a plan? Is it just for tax savings? Is it for retention of the office? Is it to save more money for retirement? Like I think there's a lot of different reasons to do it. I guess with that said, is there like a go-to thing for you, Ryan, of you're like, oh, this is where I would start of like the main priority for setting up a plan in general?
Yeah, it's our boring go-to answer, which is get organized first. I have no idea. I have
Yeah.
no idea if you should just have like a little all the way down from an actual, you might even qualify for a straight up Roth IRA.
Yep.
All the way up to a huge pension plan. I have no idea. I mean, it's just, we'll probably get into this, but yeah, there's just a lot of questions to know, which is, I mean, you could probably overlay this onto the insurance conversation. This is what's interesting about our industry is you could go to a retirement plan person who specializes in just one type and probably get sold something within 5 minutes of like, oh yeah, have this, right?
Yep.
Set up this type of plan without knowing. And there's just a lot of things to know about someone's situation before getting into them, especially the higher you climb on the ladder of like complexity and bigger size plans. Once you start getting into even, let's say 401k, but for sure profit sharing and cash balance plans and pensions, there's a lot of data that you just have to understand it, and you have to understand it not in a vacuum. It's not just about how much money do you have left over or what's your tax bill. It's what else is going on in your huge picture. So again, that's why our whole process, our first client engagement, all the work we ever do always begins with organization, data, and some kind of metrics and reporting that tell a story before we dive into it, or help us ask more questions. What does Christine say about data? It doesn't tell the full story, but it gives us more questions to ask.
Yeah, it just gives you the right questions to ask.
I love that. So that's what I would say. Yeah,
I think it's a good point. I like that you brought up like talking about all the different options that are there. Whether you might qualify to make a direct contribution to a Roth all the way up to like a cash balance plan. I think all that comes down to understanding what is your income. So like what level of income are you at?
Yeah.
Because to qualify to make a direct contribution to a Roth IRA, your income is going to be much lower in that case than if we're talking about a cash balance plan. So I think the one data point this comes back to would be, what is your income?
Yeah, if you had to point to one single thing, huh? Yeah, it's what is your income? Yeah, that's probably
and probably your overall cash flow situation.
Yeah, well, I mean, what's left over from it?
Yep.
Yeah, most definitely. That'll have a huge impact. But you're right. I think that's the question, what's your income? Which is an interesting one because most dentists, in our experience that we've met with, don't know that number really well, which is understandable. It's hard to pin down. And then most dentists are really familiar with collections or what's sitting in the bank account or what got filed on the personal tax return. But what was the gross amount of money that you actually made that does impact your cash flow and what's left over and also impacts your tax filing status? So, and that's a hard one to pin down. It's probably not the scope of today's podcast. That's probably podcast 73, I think, from 2016. I don't remember.
Exactly.
I don't know.
I think there's also an important distinction to make here if we're talking about where are you in your career. So there's a big difference of an associate to asking about how to handle like a 401k, let's say, versus a practice owner of like, should I set one up or should I not? So really simple answer for an associate, we can go there really quickly, is if you're an associate and you have any level of match from the practice, the answer in almost all cases is at least contribute right away whenever you're eligible, at least up to the match. That's like a really simple, like if you're an associate, you take nothing else away from this. It's if there's a plan at the office and you get a match, contribute at least to that match. It is a guaranteed 100% rate of return on those dollars.
Yeah.
Like you are literally getting the dollar for dollar match. That's 100% rate of return.
Now this is making me think about another general thing we could have said in the beginning. Such a good point, which is why I love them. I think we could say why we love retirement plans for clients, for dentists specifically. People familiar with our content will hear us say this all the time. There's never a shortage of times in a dentist's life and career where they need money. They need access to cash all the time, and it's really common to be grabbing it from different sources. The retirement plan is just this place. I mean, you can get the money, but it's going to be taxed and penalized in most cases. But it's this place that just locks away money, guarantees you're not going to mess with it, and it's just going to have its chance to do its thing and grow over long periods of time. And it is kind of amazing. You've probably seen this in more cases than you could ever remember, which is people go through phases and struggles and they need money, but the retirement plan is like the untouchable thing. And sometimes it ends up being the only thing that doesn't get touched or messed with, from like it just doesn't get, people don't touch it. It just stays there and grows. I want you to actually say something about the fidelity study of people who have passed away in their 401ks. But secondly to that, I also want to say what I love about retirement plans is when there's market volatility and certain people are tempted to go mess with their investments and they want to like jump in and out or to, like try to trade news or whatever. It's funny because it's usually the 401ks that like they don't want to day trade the 401k. They're like, I don't really care. I don't really. It's the brokerage account. It's the it's the things that feel more urgent and accessible. That's why I love retirement plans. I just feel like there's so many positives. So to your point, if you're an associate and you have a chance to get a match, just like put some money in and get that bag, as they say, as the young people say.
It's of course the young
Sorry,
people,
producers.
the cool people.
Our producers, our marketing team hates that we talk too much and that we try to use young lingo and slang. I'm sorry.
Although I did hear from Michelle that she said the last episode she edited for us, she did giggle. She said, and I quote, "I laughed and I cringed."
Well, then we did our job.
We covered the whole spectrum.
Yeah.
So it's interesting you said that, Ryan, because it's interesting how the people on social media that you see from time to time, we see on the TikTok and Instagram
on
and all
tick
that.
And the talk ticks.
On the tick, on the talks.
Yeah.
So the people that will disparage Ks, let's say, or retirement accounts in general, the people that will disparage them are disparaging them for the very reasons that like we think, like they're highlighting what they're saying are weaknesses that we would highlight as strengths. And it's what you just said.
Yeah.
Like the behavioral aspect of putting your money away and even though you can touch it, and if you actually know the rules, there's a lot of ways to get money out of a 401k or an IRA or whatever.
Yep. Especially an IRA.
Yeah, but
more fluid.
But the mental block that is put in place is actually a benefit, in our opinion, when it comes to saving for retirement.
Yeah. What's the fidelity study about returns on retirement plans from deceased people?
Yeah, this
or
is
is
kind
it
of
people who forgot about it or something?
Yeah, so Fidelity did a famous study. I mean, we say famous; it's all relative.
To us.
Famous to us,
Yeah.
to us nerds. But Fidelity, I actually don't know how many times they've replicated this, but I think it's been a couple where they did studies internally. And if you don't know, Fidelity is one of the biggest, if not the biggest, brokerage firms in the world. They did studies on basically internally the best account, or the accounts that the best returns. So not like the investments, but the actual accounts.
Yeah, which is two different things.
Account by account. And they found pretty unequivocally that the two categories of accounts, they found a theme. The two categories of accounts that did the best were twofold. Number one, people that were dead and that family had not claimed their accounts. And then number two were people that literally straight up forgot that they had the money there.
Best performers. Yeah.
Were the best performers.
Yeah. Yeah. So anyway, we can go back to your question, which was, or your point, which is around if you're an associate and that's what's available to you. But that, I'm glad we went there. That just helped me remember why I love these things so much. They become one of the best, not the biggest over time. I mean, if a dentist is truly building a really balanced balance sheet, it's not usually, because of limits, it's usually not going to be the biggest asset on a balance sheet, but it can be one of the most consistent, maybe highest performing based on behavior and longevity, and just most solid pieces that's just always there. And sometimes when people just go through rough patches and they have to drain lots of accounts, it's often the last thing standing that still puts them in an okay spot, for future retirement goals. So
Well,
Yeah.
this is why I have become, we did this on 2 Cents a while back, the new rule that Trump signed an executive order giving private equity companies now can access the money that's in 401ks. Like there's $12 trillion in 401ks today. That really frustrates me because of what you're saying, Ryan, where 401ks should be treated like that, where set it and forget it. You shouldn't day trade your you shouldn't day trade, period, but certainly not these types of accounts. And I find myself really frustrated with that rule change because there's no argument you could make that it benefits the end person, the end consumer.
No, it's someone has a little bit of lobbying power and they're like, can we get into that cookie jar? Cool.
Yeah. Private equity wants access to the $12 trillion that are in 401ks.
Shocking.
So, shocking.
For the average person's benefit, totally though. It's totally for the average person's benefit.
Definitely
because it'll outperform their mutual funds and blah blah blah.
Yeah.
Okay.
Yeah. Exactly. So the associate's pretty straightforward. If you get like from a decision standpoint of how to use these. A 401k specifically, if you get it up to a match or at least up to the match right away, from there, to your point, Ryan, it's going to come down to a lot of decisions around cash flow and liquidity and all that kind of. What's your tax rate? Are you going to be buying a practice soon or not? I think maybe breaking down more on the practice owner side.
Okay. Yeah.
Of how much can you actually save? Give some kind of like maybe some benchmarks. Because we're saying, and I think we agree, that cash flow and income are the biggest factor here of what type of plan to put in place and like where to put that money, generally speaking. Would you say that?
Yeah, for sure. And I was going to ask you, it is in the notes here, and I think it might be an important point. Do you want to say anything about understanding your tax rate? This is an interesting thing too, because even if you pick the right plan for the right time of your life, the right scenario, everything, there are tax circumstances year to year, depending on other things you have going on, purchases, appreciation, write-offs, whatever, income fluctuations, losses, who knows, that might change whether or not you should at least utilize or max out that plan that year. So did you want to say anything about like just understanding your tax rate at a high level? Yeah, I think it's super important to understand your tax rate and understand something that's often misunderstood, understandably so, by the way. The tax code is like 70,000 pages. So
taxes are like intentionally meant to be confusing. But one fundamental piece of this that I think a lot of dentists confuse is the difference between effective and marginal tax rates. So marginal being the marginal tax rate being the tax rate that's attached to each bucket, right, within that bracket. So it starts at, it technically starts at 0%, but the first taxable bracket is 10, then it goes to 12, so on and so forth, up to the max that have now been made permanent by the current administration. Max marginal rate, top marginal rate is 37%. But that is vastly different than your effective rate, which your effective rate is the average, taking where you fit in all those buckets based on your income, and really what's the average rate based on how high your income is. So your effective rate will always be lower than your marginal rate.
Yeah, always. Which, not everyone understands that, which it's a funny paradox. Not everyone understands that, understandably.
Yeah, understandably. But here's the key point here that I think, again, this is misunderstood. And I think I'm glad you brought this up, because when we talk about why a retirement account can be so effective for high earners is because when you're putting money into, so this is debated with nerds on social media of like, should you always do Roth or should you always do, or should you do pre-tax?
Yeah.
Again, there's nuance to this, but just generally speaking, if you are high income earner, let's say in the top marginal rate, every dollar you put into a retirement account, into let's say a 401k, is tax deducted at your highest marginal bracket.
Yeah.
When you go to pull money out down the road in retirement from that account, it is pulled out at the effective rate. You're filling up the lower bucket. So that's again,
big distinction.
Big distinction. Your effective rate is always lower than your marginal rate. So if I just told you you're going to get the tax deduction at your marginal rate and you're going to pull the money out at your effective rate, chances are there's a solid, what we'd call tax arbitrage, tax benefit, tax premium to be using a retirement account, assuming you're in the high brackets.
Yeah, assuming. Yeah, which is I keep thinking of things to talk about generally speaking with retirement plans. Do you think, Matt, 'cause again, you mentioned the arguments of like pre-tax versus after, do you use Roth or pre-tax or whatever. The argument is, a common argument is that it's impossible to know what's going to happen to the tax rate in the future, but most people argue it's going to be higher. Taxes will always be higher.
I don't know why everyone says that.
I know.
Honestly,
Like,
taxes have only gone down for the last 70 years.
Not supported by history.
Not supported by data.
Not supported by data.
Yeah.
That's usually the argument. Do you want to talk about why we still feel like, even though we don't know what's going to happen in the future, why it does it seems like it tends to make sense for a high income, high bracket, peak earning years dentist to do pre-tax deductions now versus try to do everything Roth or after tax, and then the assumption is that they'll just taxes will be so much more money in the future, so pay them now. That's the whole basis of the argument.
It's always that assumption, and again, might be the case for sure. I have no idea, but taxes have only come down for the last 50, 70 years. So it's really hard to raise taxes in America. Now, if you're making the argument that, and I think this is valid, of saying we are really going down a road here, but just broadly speaking, if the argument is we are in an unsustainable path as a country with our deficit with our negative deficit year to year that has been going on since the turn of the century, and our very much can continue increasing debt load as a country, and you can just see the aging population, people are having less kids. If you're making an argument out there and saying, well, taxes are going to have to go up because to sustain or to eventually stop this, but just to say, well, taxes are low, so they're going up. Again, history does not support that. It's really, really difficult to raise taxes in America. Because no one likes them.
I mean, they're going to get fought against forever. And we're trying to make the assumption that, again, dentistry being one of the top, if not the top income earning profession in the country, statistically is Department of Labor, but when you really know how dentists make money, the argument is that, look, it's just highly likely that the income that you pay taxes on, and it's earned income. Dentistry is an earned income, so it's highly likely that the income you have to pay taxes on in the middle of your career, throughout the whole career, the income number will be lower than the income number when you're done working. Because your income number in the future is whatever you pull out of your investment accounts. And, if you have rental properties, that's income too. But we're making the argument that your income today, not the rates, because who knows, but the income today is going to be higher than the income in the future. And it's interesting that there's such an argument, but then again, every high income person wants to save taxes. They'll do anything to save taxes. So it's interesting that argument exists, but
well, and again, such a good point, Ryan, because I know because we've seen this firsthand of the assumption that dentists make. When you tell dentists that, a lot of times you'll get kind of a confused look, wait, I'm going to make less in the future. My lifestyle's the same. I think people don't often think about that in retirement, most of the time, your income is just going to be matched
it's your
with
spending.
What you spend. It's what you spend.
Your income's your spending.
Yes, for the most part. Again, unless you've got a bunch of real estate and you're bringing in passive income, okay, great. But if let's say you are a typical dentist who saves a bunch of money within brokerage accounts and 401ks and has a big practice they're going to sell and eventually transition that into a brokerage account, and you've piled up all this money, your income, generally speaking, is going to be basically very much tied to how much money you need to live. Where when
whatever
you're working,
you pull out to spend,
whatever you pull out. But when you're working, your income is actually what you make. So when the typical dentist that we work with makes $500, $550 in that range, you're most likely not going to be putting that on your tax return in retirement.
No. And if you're a dentist who built a net worth where your income, your forced taxable income after you're done working is higher than when you were working, good for you.
Congratulations, you won the game. You won the game.
Pretty hard to pull off. That means you amassed so many assets that are forcing you to take income from them. And it was more than you ever earned in your whole career while you had a job. So
congratulations, you're clearly a Dentist Advisors client. So
you did it. You followed the DA way.
You followed us.
Okay, let's go back. We were going down the road of different, not just income ranges, but cash flow ranges and what cash flow ranges. What we mean is how much money do you have left over on average in a typical month, and try to match up the most appropriate likely retirement plan with that savings amount, right?
Yeah, because I think that's helpful. Again, if we're giving general advice,
it's good benchmark
to a bunch of people, and we're saying the real answer is this depends. We've got to look at your balance sheet, get you organized, understand goals, concerns, what you're trying to accomplish, all of that. But if we're just saying you're out there listening and thinking, okay, give me a general benchmark of if we're saying income and
I've
really
got $2,000 a month left over. What's the plan I should look
Exactly.
at? Well, profit sharing's off the table. 401k is probably off the table. Yeah.
Yep,
I love it. Yeah.
So let's start at level 1. So trying to match the plan with where your savings number is. So you just said it. So let's say the starting point is let's say $1,000 to $2,000 a month.
Yeah, a couple $1,000 a month in savings.
Couple thousand bucks a month. If we're just focusing on your situation as a dentist, so not factors like, hey, my staff is bugging me to set one up.
Totally.
I'm having retention problems. We think this would be a big help. If we're just saying your specific situation, what should I be looking at setting up a plan, or what type of plan to contribute to? So $1,000 to $2,000 a month in savings, that's going to be IRAs all day long, whether that be a traditional or a Roth, depending on your situation. Any thoughts there?
No. Yeah. And I just always like to reverse the math in it. If you have a couple $1,000 left over every month, it could be because that's just where your income's at. And that's just what happens to be left over. Your income could be higher. I mean, you might be in a higher, and this is where it gets frustrating for some people. You might have a higher income and a higher tax rate and tax bracket, and you're like, oh man, I want more deductions, but the leftover money you have is just lower. It could be a product of you spend too much money, so there's just not enough to save. It could also be a product of the way you finance your practice and the debt load you carry right now and the payment structures that you have, where the payments just chew up a lot of your free cash flow, a lot of your after-tax dollars. So you might are possibilities where your income's higher and the amount you have to save left over every month is lower. A lot of times, though, it'll match up. A lower amount of savings, at least the people we work with, will match up with a lower income. And with the lower incomes, you're just a great candidate for personal IRAs and even a Roth, like you said.
Yep.
Yeah. I remember doing these. I like these benchmarks to just as a place to begin. These are just starting points. Got $2,000 a month left over, some IRAs and a Roth, and call it good.
And probably if there's any extra left over beyond that, brokerage account's a great place to go.
Oh, yeah.
But in that range, $1,000 to $2,000 a month. And I like the distinction that you make of, there's a lot of reasons why you might only have $1,000 to $2,000 left that we'd have to dig into. Like, again, it could just be really a high debt load, normal. It could be you're spending too much money, and we got to talk about that.
I would say it's probably dentists carry tons of debt and have a lot of debt service, especially early on, but spending's a culprit, more often than not. So, yeah.
So $1,000 to $2,000 a month. When we get to 3, I'm going to change this up a little bit and say when we start to get in above $3,000 a month, we're saying in free cash flow, money that
you can
left
save
over or that you need to be proactively putting somewhere. $3,000 a month is the minimum that we'd want to look at before we would even broach the topic of any type of plan.
A retirement plan.
Yeah, at the office.
Yeah, and
here's another 5, to be honest. But
yeah, I was going to say between 3 and 5, right? Yeah, and so another side of this logic is that ideally, and it doesn't happen perfectly in a vacuum like year in, year out, but ideally, and this is the way we work with our clients, we don't want dentists putting all of their free cash flow in a retirement plan. For the exact reason we said it's a benefit earlier, dentists do need access to liquidity. It's very, very important to build liquidity as a dentist. It's a part of the financial planning and investment management process that we do with all of our clients. So we're trying to get to a point where you could take advantage of maxing out a plan while also still having something left over to build liquidity with. So when you start to hit that $3,000 to $5,000 range of leftover cash every month, it does start to put you as a good candidate for a simple IRA based on the max limits of a simple IRA and being able to take advantage of those limits while still having some left over outside of that to build liquidity and, keep yourself safe and secure in low stress with liquidity. So I think that's the range, 3 to 5, somewhere in there. Simple IRA.
We don't want you to be house poor. We also don't want you to be 401k poor.
Yeah, that's great. That's a great way to put it.
Well, we put a premium on optionality and flexibility. And I'm glad you brought that up too, Ryan, because the other factor here that we need to consider, if we're going through a checklist in a dentist's mind of when do I consider any of these things prior to understanding your cash flow. And again, you said it earlier, this is why it's so important to be organized, but understanding your liquidity and do you have proper liquidity at home and at the office first, and then turning to your cash flow. I think those are kind of 2 huge factors here. And to your point, we don't want you putting every last dollar you have in 401k.
No, again, we said this in the beginning. It is always true that dentists throughout their career just need more. They need access to money and liquidity more often than they ever think. I mean,
Yep.
it's opportunities and emergencies alike. Yeah, so that's I like that we went there. That's another part of these thresholds, why we put them. So yeah, if you're like, I've got $3 to $5 grand left over a month, what's the retirement plan I should start thinking about? A simple IRA could be a good entry level candidate, and true to their name. I mean, this isn't probably the podcast where we like
Rip on simple IRAs.
yeah, or like compare them, but they are easier. They are more simple to set up.
Are they? I don't know if that's true anymore.
Yeah, I mean, not ongoing is the problem. I do think they are a little easier to set up than like a 401k just based on the stuff that has to happen, but it's probably also the 401k company running it.
We're gonna put a pin in this for real, because there's another part of this as we get through this that we'll talk about what goes into setting up a 401k.
Oh, okay,
and
yeah.
We'll bring back this comparison at that point.
Okay,
Let's do
so
that.
great. Well, yeah, that's a subject for another day. So it does beg the question, but a simple is a good place to start asking questions. Like that might be a good place to begin in that 3,000 to 5,000.
3 to 5 range, 3 to 5,000 a month. We're starting to talk about cash flow makes sense, assuming you've got liquidity, of starting to think about a retirement plan at the office of some kind. Once you get above that, you're above 5,000 a month. You're saving, or you have the ability to save 6, 7 plus.
Yeah,
now
6, 7. Sorry, I can't. I'm around teenagers, dude. I can't not. I'm sorry, Michelle. I'm sorry, marketing team. 6, 7. If you say 6, 7 these days, I can't not hear it. I hope so. $6,000 to $7,000 a month starts to put
range.
You.
Well, then you should probably most likely already have a plan at the office for 401k, and then that's where we start talking about layering in profit sharing.
Yeah.
So
really fast, just some of the math on a 401k limits. What's the limits in the next coming year? Do you know? Is it 23 in the next coming year?
23.5. I will double check that real quick.
But if you're talking about an owner,
2026 or 2025?
Yeah, 6 coming up.
2026. Yep,
just
I got
curious,
you.
Since we're like almost in October 2025, just so crazy.
2026 is going to be 23.5.
Yeah. Okay.
Sorry. 23.5 is for 2025. For 2026, it's going to 24,500.
So it is going up. So if you take an owner and a spouse both on payroll, maxing out a 401k, it's $48,000 a year, almost 50 grand. We're talking about $4,000 per month in savings, in cash flow savings. So this is where, to your point, I love that we're on these benchmarks. 4,000 of your 7 is going to go to the 401k if you and a spouse are both on payroll, which still leaves a few $1,000s left over to build liquidity in ideally and likely a brokerage account.
I'm glad you brought that up, because I want to push these ranges up actually. So I wouldn't even really be talking about it with the client, or if you're out there thinking about it, we'd want to look at your cash flow. I think a 401k, I'd want to see a sustainable, probably minimum 5, more like a 6, 7, probably more like 6, 7 a month in savings, because we want to leave that buffer. So I think that's where we're at. Is
you do. You need that you need that liquidity. Dentists just have to have it, which is why you might have a person with $2,500 left over, or you might have a person with $2,000 left over who goes and sets up a 401k for themselves, because technically they could match that out next year, or max that out, right, with the 24 grand a year, $2 grand a month. But what does that leave someone with after tax? It's not there. I mean, then I don't know if we're going here, but there's an entire mathematical part of this where it's like, all right, if you maxed out a 401k with you and your spouse, if you were both on there, that's a tax savings of X amount of dollars. What are you doing with that in your cash flow? Where is that going to go every year as your taxes do come down? So, which is,
what's happening with that? It's getting spent.
That's what I'm saying. Unless there's a meticulous process that someone's kind of obsessed with, and the data and the numbers and the tracking, you can save 15 grand in your taxes this year. But if you don't realize that somewhere from last year's cash flow or comparatively, then you're just going to spend the extra tax savings. So then you're going to be in the same boat where you're like, I paid too much in taxes. Like, well, you actually lowered it last year, but you spent it.
Yeah,
and you didn't even know you spent it.
Yeah, it's so true. And this is actually one of the arguments that is made for doing a Roth, even within a 401k, because in reality, when you put money into a Roth, you're technically saving more money unless you actually go and take that tax savings that you would get and invest that elsewhere. Yeah. So just to give you an example, put some real numbers to this. You and a spouse are maxing out a 401k, $49,000. You are at the highest tax bracket of 37%. That's a tax savings because those contributions literally reduce
At
your
that
taxable
end, yeah.
income. So your tax savings on those dollars, just at the federal level, is $18,130. It's $18,000 in tax savings at the federal level. But if a lot of times it's just numbers on a piece of paper that's like, cool, but if you actually just go spend that money, did it really do anything for you?
Spend $18,000 then, but do it intentionally. Like actually know that you saved $18,000 in taxes because of your strategy and your plan, and you took that extra money that last year you had spent on taxes, and now you vacationed 3 times, fully paid for in cash, and like whatever. Be intentional with it. But yeah, it's a really good point. Between Roth, where do we end up? That's kind of 401k.
So we've clarified the range upwards. I would really want to see more like $6,000 to $8,000 in free cash flow. I'm going to avoid saying 6-7
skip it.
for the 401k. And then if we get again above in those ranges, we want to start considering profit sharing. So just to highlight a review of profit sharing, this gets confused a lot, I think, for people. So retirement plan at the office, 401k specifically, there's 3 funding sources that go into a 401k. There's the employee contribution. As a practice owner, you are both employee and employer. There's employee contribution. That's the cap of $24,500 next year that we were highlighting. Then there's the employer match. So your company, the practice actually matches for you. And then the third way to fund a 401k is through profit sharing.
Yeah.
Every year is discretionary. So you can decide each and every year. It has to go through what's called testing. ERISA rule regulated testing to say, based on your staff, the size of your staff, the ages, their income, what's your matching formula. The actuaries basically tell you, based on regulations, here's how much you can put into to profit sharing. Here's how much goes to you versus your staff. That each and every year you can decide based on the numbers, yes, I want to do it, or no, I don't.
Yeah.
But that's another layer into this that can go above and beyond your 24,500 plus your match. You could literally, through all of these sources, between the 3 we just highlighted, if it's you and your partner on staff, you can get into the 6 figures.
I'm just searching. Do you know off the top of your head
what 70,000?
Yeah, it's right up there, right? Because it used to be in like the mid 60s, and now it's climbing up there. Yeah, it's got.
I want to say it's 70,000 now. We're saying you're saying the total amount you can put in between those 3 sources.
Your 401k, paycheck deferrals, and extra profit sharing, and the portion that the company kicks into you, including the match and everything.
Yep.
Yeah, but now we're talking. That's for one person. So an owner and a spouse on payroll who are both eligible. I mean, this of course it does get more complex and depends on a lot of scenarios. But now we're talking about almost $50,000 of just pure 401k deferrals, and then another like 1,000 or 40 grand ish. Yeah, 45,000 of extra elective deferrals through profit sharing that's possible. That's where you get your 6-figure per couple is very, very possible.
Yep.
And even more possible when the spouses are both high income dentists. It's a little less possible to get a lot of profit sharing for a spouse who's just like on payroll for the 401k and doesn't have a lot of like high income in the practice. Yeah, profit sharing's really cool so what would you put that savings number at every month if you got 8 to 10 ish left over?
Yeah, I think you'd want to be at
10 plus?
8 to 10 grand a month in free cash flow to be considering profit sharing in most cases. And then as you get above and beyond that, and this is usually going to be a later stage dentist in your late 40s, early to mid 50s, and maybe you paid off some debt. Now the cash flow is really opened up.
Yeah.
Now we're starting to talk about layering in a defined benefit plan, a cash balance plan.
Yeah. Is it worth saying here that usually for these plans, starting with profit sharing, and then as you get into defined benefit, cash balance, and pension plans, though the calculations that decide how much your team gets when you put in a certain amount of dollars, those calculations are heavily age dependent. So maybe it's just worth saying that typically when we get into this level of plans, it's not just about how much money you have left over and what's possible. It's about team dynamics, which includes how big is your team, how many people. Is it you as the highest paid person, then a bunch of team, like normal paid team, or like is it you and a bunch of highly paid associates in team? And is there 10 of you or 60 of you? And are you 38 or are you 58? Those things start to matter a lot in the calculations. So it's not just about cash flow, but that's the cash flow has to be there. especially when you get it above profit sharing and you can just talk about this. It's no longer discretionary or optional. Where profit sharing, you can say like, no, I don't want to do it. It's too expensive this year. But once you get into the cash balance and the pensions, once you sign up, it's a minimum of 5-year commitment that
I think
you
it's
have
the
to
minimum
Is it
of
3?
three.
Okay,
3.
you can get away with 3? Okay.
Yep. Yeah, you can get away with 3, but it's a commitment, and you got to know you've got stable cash flow that's at that level that you're going to put it in place and keep it in place for a minimum of 3 years. Yeah, that's a much bigger commitment. Keeping it like they're complex, and to keep them in line with the regulations from year to year is a lot.
Yeah, you'll pay more in fees to some third-party administrators, especially with pensions and cash balance and defined benefit plans. You'll pay more in fees because you have to have actuaries and sometimes ERISA attorneys review it every year and make the projections and assumptions. You have to run the reports multiple times, and then in all of these profit sharing and anything above that, you can't even really fund it until the year is totally over because you have to have total year-end census data from your practice. So it's a whole thing.
The one thing I will say, pro tip on the profit sharing piece, that if you are out there trying to figure this out and running tests, and your administrator comes back with numbers that don't look good, meaning the percentage that's coming to you as the owner is not great. We want to see that above 70% in most cases for it to make sense.
Yeah.
But let's say you're one of those younger docs. Let's say you're in your 30s or early 40s, and you've got some older staff members, which is common. We see this.
Oh, yeah. Especially in like buyouts.
Keep in mind, yeah, exactly. But keep in mind, there are more ways than one to run testing. And oftentimes it takes some pushing by you or your advisor to actually figure that out. So we don't need to go into the great detail, but just know that they're going to come back with a default way to test, and
that their software is like the fastest, easiest way their software kicks it out.
Easy. Usually going to do like the default is usually either going to be pro rata, which never looks good, or most likely what it is what's called new comparability cross testing. But there's other ways to do it. Just keep in mind that you can push back and say, well, have we thought about these other ways to test to make the number? I've seen this happen.
Oh, yeah.
Where it didn't look good, and then we pushed back and said, hey, let's actually run it with like, for example, Social Security integrated testing.
Yeah.
And now it comes back and looks better. So
that's
not to go too far into the weeds there.
No. It's a really good point. And I just think it illustrates that at some point, retirement planning is a very complex subject. It impacts tens of thousands of dollars of tax savings either way. And it often is not a set it and forget it thing. It has to be reviewed at least once per year. In some of these bigger plans, you're going back multiple times to the actuaries or whoever's running everything to double check numbers and run different scenarios. I mean, this is not it's not an easy, fast little job to do, but it's tens of, at that level, you were talking about a tax impact of tens of thousands of dollars. Either way. So
very true.
Yeah.
Okay. So we feel good with that breakdown.
Yeah.
I think
I like that range. Yeah. I mean, a couple $1,000 a month personal IRAs or Roths, 3 to 5 a simple. Again, these are like places to begin asking questions. 5 to 7 401k, 8 to 10 plus profit sharing, 10 to 12 plus, 15 plus cash balance defined benefit. More complex the bigger those plans get.
Yep.
Yeah.
And then let's just break down really quick. If you're an associate, again, we already hit the 401k. If you've got a match, great. If you're let's say an independent contractor associate,
more rare now, right? I was going to ask
much
you, how
more
have you
rare.
seen this?
I don't
I'm not seeing
see
it that much
as
anymore.
much. I don't see it as much. But let's say that they're still out there. If you're an independent contractor, and that you're going to be basically down to either a SEP or a solo 401k. I'll say this: in my experience, very rarely does a SEP beat a solo 401k.
Yeah.
I would prefer a solo 401k in almost every case.
And they're getting easier to administer solo 401ks. They didn't used to be that easy to do. SEPs were always just way easier to set up. But yeah, the solo Ks are just, more efficient. Much more efficient.
I think they are. And usually you can get more money into a solo than a SEP.
Yeah. More money, more efficiently.
The caveat to that, sorry, really quick. The caveat to that is SEPs have some flexibility to them of like setting up at different deadlines, where a solo 401k is a little bit more restrictive. So there are situations where it's like, hey, let's get the SEP set up really quickly and all that before the deadline because they've got, again, different deadlines in the solo. But in most cases, solo would be better.
We're going to get in, I think, to parts of these, like who's involved when you set up these retirement plans. Are we going to go there? There's not a part 2 to this, right?
Yes.
To be
No,
clear.
we're going to do this right
Okay.
now. Well, yeah.
Our team will kill us if we do part 2 also.
We're not doing part 2. We are
Okay.
going to carry on and push through.
So deadlines. Let's get into, as we get into this other part here of what goes into setting up a plan like this, like who's involved.
Yeah.
We can talk about deadlines too, but let's jump into this. What's involved when you set up, let's say anything 401k and above. That's what we're talking about.
Yep.
Who's involved with this?
Yeah.
It's simple, a little bit easier. Less people.
So this is where I wanted to bring this back up is when we talk about a simple versus 401k. Technically, yes, a simple IRA is easier to set up because you don't need these things that we're going to highlight.
Yeah.
But I'm going to argue that this is why a 401k in most cases is better because you have these other things involved.
We're on the same. This is my argument too. Yeah, it's easier and faster to go set up the simple because it's kind of like everyone just gets their own little IRA and it's like done. But because of that we almost always will come back at some point down the road when you run your simple IRA and make you deal with something that if it was a 401k, someone else would be dealing with.
Yeah, you'd have someone else to do it. So with that said, let's talk about 401k and above. Let's 401k specifically. The parties involved, we're going to say the first 3 you have to have. And then the 4th is an option that can often make it better or easier. But
and the 5th kind of is an option because it can be you. The 5th one is like, it could be you. So it's an optional if you want to outsource it.
Yep. Okay. So number 1, you need a TPA, a third-party administrator for a 401k. Secondarily, you need a record keeper.
The TPA do? What's their main job? You want to say?
Yeah. So their main job is what we'd say administrative duties and making compliance, tax filing, making sure the plan's being administrated correctly,
following rules.
Yep.
Yeah, and especially the more complex it gets. I don't think people know that if you have a 401k, it files its own tax return.
Yeah.
If 401k has its own tax return that has to be filed, you're welcome to do it. Don't.
Yep. Don't.
Welcome to it, but don't. Yeah.
And then the next is record keeper. Oftentimes you can, well, I shouldn't say often, but it is possible, and it's becoming more common that these are the same group.
Yeah,
same. You have a bundled service. Sometimes you'll have a TPA that works with a separate third-party record keeper. But like, for example, the group that we use for like our preferred group is a bundled approach. They do third-party administrator and record keeper.
Yeah, record keeper is like account management. It's your logins. It's like your training. It's like working with payroll. It's getting things like filed week to week when, funds are moving around and accounts are getting set up. And
dare we say they're the keeper of the records?
I was just gonna say, like, it's where the statements come from a lot of times, and like they're the keeper of the records.
The keeper of the records.
Why don't we call things like that anymore? I feel like in medieval times we probably called like the keeper of the records. Now we're just like record keeper.
Yeah, we
should get back to that.
We need to go back to that.
Okay.
Third is the custodian. So this is where the basically the platform where the money is sitting. This could be Charles Schwab. This could be Matrix Trust Company. This could be Fidelity. But the custodian is where the bank, where the money is held, and the platform in which you invest on.
Because those 3 are not optional. If you have a 401k or above, you have to have those 3.
You need them. You need these 3.
And I'll say this: not optional if you have a profit sharing and especially cash balance or pension or defined benefit. You also have to have an actuary on top of those, which again might be a part of the record keeping team or the TPA
would most
team.
likely be.
Most likely usually is. They're the ones who run that separate set of calculations Matt was talking about earlier to determine which way to fund profit sharing. And
Yep. And optional here would be investment advisor. So technically would be called in the plan a 338 investment advisor. They are the ones taking on the responsibility of, do we have the proper investment kind of lineup and menu within this plan?
Yeah.
To make this compliant.
Is everything being managed correctly? And
just for what it's worth, it's not super, super common, but it is like, it's not uncommon that the plan sponsor, so a dentist who is running a practice would be considered the plan sponsor, who has a 401k, is sued at some point by an employee for 401k. And almost always the number one reason for a lawsuit is because of the investments.
Yeah. Lack of selection, poor investment selection. Yeah.
Yep.
Have you seen a 401k lawsuit in dental?
I have personally not seen it.
I've only seen it, now that I'm thinking about it, I've only seen it with bigger plans like pension, cash balance plans where funding didn't happen properly for like many years in a row. And then like a retired employee came back and was like, my pension's not correct. You were supposed to add more amounts to it. And I've seen that actually.
Yeah.
Which
So
begs the whole DIY thing question later.
if you're setting up a cash balance plan or you're at that level, I would not be doing it
That would be
yourself.
insane.
That'd be crazy.
Even the
For
401k, there's so many redundant bureaucratic processes and compliance issues that, things you have to check off the list, even in a pretty typical 401k that can get messed up.
Yep.
Yeah. It's
Yeah,
just not worth it.
I'd most likely not be doing a retirement plan on your own, but up to you.
Yeah.
So again, we've got that. Third, TPA, record keeper, custodian, investment advisor are usually the team that most people we'd recommend. Well, the first three are required, and then investment advisor, again, totally up to you.
Yeah.
That's an optional piece. But if not, then you are acting as the 338, meaning you as the doctor, owner of the practice.
So if there is a problem, if there is a lawsuit, it's back to you. It's not on your advisor. It's not on the bank. It's not on the TPA. If you are the one who are the end point fiduciary, and this is something you sign in the documents when you set up a 401k, if you are the end fiduciary, it's coming back on you if there's a big problem, which is why picking a good third-party administrator that will take on the fiduciary roles as much as possible, an advisor who will take on the fiduciary roles as much as possible is really important, really helpful.
Yep. Yeah, I think so. I think so too. And to your question earlier of what the TPA does, they act as another level of fiduciary responsibility, which is called the 316. To your point, you want someone to be taking that on because you don't want to have to deal with the administrative burden.
Because the cost of what? Every year, if you have a 401k, you have all these people doing this stuff, not the advisors, that's a separate thing on how you pay your advisor, but having a TPA, someone run your 401k, what does it cost you every year? Approximately.
Oh, to actually run one.
Yeah.
So it's a range, but I would say expect a couple $1,000 a year, $3,000 a year.
Yeah.
To run a plan every single year. And by the way, there's oftentimes now tax credits that you actually cover the cost of setting up a plan.
Yeah,
the government is incentivizing you to set up 401ks. Oftentimes tax credits will cover the entire cost.
Well, now that private equity is involved, like, hey, you guys, we're just feeling generous over here at the IRS and the government. We're going to just make it a little bit easier to get a 401k and get some money in there. No reason in particular. We just want you to have bigger balances. So.
You can invest right in these private equity funds that are high fee crap.
Yeah, they have a 2 and 20, but this. Anyway.
We don't have strong feelings about this at all. Anything else you'd say on any of that?
No, it's just that's good structure. That's good setup. I mean, I hope people are gonna just appreciate that this stuff it gets complex, and this is not worth your time. If you're talking about an expense that might cost you $2,000 to $3,000 per year, that is just not worth your time as a high-producing dentist. Get it off your plate. Don't deal with it. Don't have backlash come back 10 years later after running a plan the wrong way because you saved a little bit of money up front. Just do it the right way and go, do one more crown.
Yeah, there you go.
Do one more implant that month and then pay for the whole thing for 5 years. I don't know.
Yeah. Okay. I think that let's recap. Anything else you want to say on any of this?
No, high level. Again, there was a point you made in the notes I thought were really good and you kind of, when you talk about finance influencers on social media who disparage retirement plans, they'll usually disparage it by talking about a retirement plan as if it's an investment itself.
Yes.
For example, let's say 401ks perform poorly. They have bad performance, which is nonsense because 401ks don't have performance.
They're just an account.
It's an account. It's a shell. It's a thing that holds investments. Those investments might have poor performance, but that has nothing to do with the fact that it sits inside of a 401k. So it's a misleading scare tactic in marketing to sell something else to owners of 401k. So you have that in the notes. So the distinction between these are account types. They just hold investments.
Yep.
It's a good distinction to remember and make.
I think it's a great distinction. I've actually heard this so many times in my career, people being like, oh, Roth IRAs are crap. And it's like, well, what do you mean? It's like, well, I've had one for 10 years and it's done nothing.
Return's bad. Yeah.
And I'm like, well, have you invested it?
Yeah.
What do you mean?
Well, it's in a money market inside.
It's in a money market. It's like, well, yeah, of course you haven't earned any. So it's a really good distinction to make.
Yeah.
And again, coming back to the social media gimmicks, let's call it what it is. They're gimmicks so if you ever see a video like that says something about 401ks being bad investments, they reference anything about returns, that right there tells you they don't know what they're talking about, or they're intentionally deceiving you.
Yeah, good.
So it's a really good distinction.
Wrap up for me. I think the most important stuff besides the details. I'm just a huge fan of this stuff. It's forced savings. It's matched savings. It's the untouchable part of a net worth. It's like, it's the closest thing you can get to putting money into an investment that's similar to like a business or a piece of real estate that you just can't get at easily. And therefore you leave it and let it grow and you don't mess with it. And it ends up in everyone's best interest. And again, I've seen many, many cases where just things happen in a dentist's life, and one of the last things left standing, besides the building or the practice, was the big 401k that got to 7-figure balance while we had to wipe everything else clean. And so I'm a huge fan of this stuff, just done the right way and checked up on at least once per year in a review with your advisor.
Yeah.
Huge fan of this stuff.
I couldn't agree more. I think you think about like the general principles of like that, taught by people like James Clear or other people like him that talk about habit formation, right? And making good habits, like removing the obstacles of good habits and then putting obstacles in your way of habits you're trying to break, right? When you talk about that with 401ks and retirement accounts, I can't help but think about that of the behavioral kind of built-in obstacles that again are disparaged online of like, these are why you can't access this money until you're 50 or 60, whatever. It's like, yeah, that's why you should have one.
Yes.
Because we are our own worst enemy with all of this stuff.
Yeah.
So, and we can all admit it. Me, you, Ryan, we're all our own worst enemy when it comes to this kind of stuff. We need structures in place. And that's one of the biggest reasons why we're fans of 401ks, even at times when we'll be totally honest that we've gotten frustrated at times, like meaning specific client situations when we're like, you know what, it would sometimes just be easier not to have this thing.
Because they're harder to deal with.
Yes, they are. But it's worth it over the course of someone's career in most cases because of the behavioral confines it puts you in. The other thing I'll say of why I like these pre-tax or, retirement accounts in general is, again, assuming that you're in that high tax bracket and you're doing this in a traditional format where you're taking the deduction, it is one of the very few things that you can get a deduction by using it and then actually keeping the money.
Yeah.
So 401ks, traditional IRAs, simples, SEPs, HSAs are pretty much the only thing in existence that you can put the money away, keep it for a later date, and also get a deduction. Yeah. Every other deduction that's out there is a net negative to you. Yeah. It's meaning you're spending money, charitable giving, buying equipment, taking a loss on an investment. The deduction is a tax savings, but a net negative overall to your after-tax wealth. And that's why I like these because, and I think you should take advantage of them because there's only a few things out there that you can actually do that with.
That's, and I was just that was another thing that I'm not sure we touched on totally. It is unfortunately one of the first answers to when dentists say, how do I save money on taxes? It's unfortunately at the top of the list, and it's a boring list of things dentists can do proactively every single year to maximize their tax savings. It's have the biggest, most efficient, maxed out retirement plan that's most appropriate in that given year, every single year of your career. It's such a good tool. So
yeah, it's so true.
Shout out retirement plans.
Shout out retirement plans. So really quick.
You know who you are.
Yeah. You know who you are, guys. So let's just summarize this really quick of things that go into deciding where to put the money or what plan to have. Okay. So savings, so your ability to save and the level of savings you have, which is consequently part of where your income level is, but really just your overall cash flow. Yeah. What is your savings? Depending on the range you are in savings is going to dictate what type of plan to put in place. Your tax bracket. Where you are on the tax bracket range is going to be a huge factor. I think stage of career is a factor here. And what are your career goals? Because this is something we didn't hit on a lot, Ryan, but there might be situations, in fact, it's pretty common that you might check the box of like cash flow, right? Of like, oh, you're saving easily 5-10 grand a month. Yeah. But because of career stage and career aspirations, we would still advocate to not set up a plan yet.
Totally. Oh, and that's
depending on what
not
you're
uncommon. Oh yeah, 100%. Yeah, you might have purchases or goals or practice strategy coming up that.
Or you're buying a building.
You need money for something else. Yeah.
So
1,000,000%.
Career stage is big, and then just your practice staff demographics.
Especially those bigger plans. Yeah,
bigger plans for sure.
Plays a role. Oh, wow. I guarantee those early episodes had Justin with a timer and a script. And so I guarantee we didn't go an hour 6 on the first time we did this.
But you know what? We got editors to cut this down for us.
Yeah, we know where that's going to be edited. The important stuff, though. This was actually a fun exercise. I'm glad we're going to be doing this more to see what we would update this time around.
Yep.
Because it's been years and things cost more, inflation's higher. It's more to run a practice. Dentists need more money for more things than when we first did this episode. So this is cool. I like doing this.
Yeah, really cool. If you're still here,
shout out to us.
Shout out
from all those years ago.
Freaking us for still being here 10 years later, still here, still kicking, still doing the thing. If you're still here listening to this, you're one of the cool ones. You know who you are.
Thank you.
We appreciate it. If it was helpful, we would ask that you share it. If there's a dentist out there you think needs to hear the message, we'd love for you to share it. We love educating the dental community and hopefully adding value. So we'd love to share the episode. Ryan, any other words of wisdom for the people?
Thanks for being here all these years. Really, this is cool. And new listeners for showing up for the first time. So that's what we got for you today. Hope you enjoyed it.
Yeah. If you want to talk to us, where can they go, Ryan?
dentistadvisors.com. And then there's a huge button, free consultation. Chat with us. Tell us your story. We'll point you in the right direction. We'd love to hear from you.
We'd love to talk to you. So everyone, thanks for listening. Ryan, thanks for sharing the wisdom. Till next time. Bye-bye.
Bye-bye.